All right, everybody. It is April 9th, almost 5 o'clock Eastern. I feel like it's important to contextualize where we are when we record, given the week that we've had. But I am joined by two of the best measurement strategists at Haus, who have been educating me all week on what the tariffs mean and how folks are responding. I'm joined by Doren, measurement strategy lead, and Chandler as well. Nick, I wanna break this conversation up into two parts. Number one is what is happening right now as we speak, as these tariffs roll out. We don't know what's going to happen, but folks are scenario planning. What's happening right now is that folks are rebuilding the financial model, and so I want Nick to kind of walk us through what that process looks like. And then we will switch gears into like, okay, based on that new financial model, what are the implications on marketing and how does your marketing need to adapt and some testing strategies and suggestions for how to adapt your marketing. Chandler's going to lead there. And then we might, if we have time, we'll riff in terms of the non-paid world and what we can do in the world of retention and organic to really kind of meet the moment. Sound good, guys?
Yep, let's do
All
it.
right. Nick, I'll kick it over to you, but as I mentioned, I'll just tee it up once again. What, like, we talked about this when we were preparing and you asked like, does everybody not like, you kind of expected that most marketers know how to do this exercise. And the answer is no. Like I have been in roles at larger companies where a marketing budget is just handed to me based on a financial model that I was not involved in. So walk us through what that model looks like and how
Yep.
you need to adjust it based on these changes.
Yeah, for sure. I can I can share my screen, but what I'm going to pull up is essentially a unit economic calculator. Um, and this is like the basis of how any direct to consumer brand, like let's for the purpose of simplifying the conversation, let's say this is like a one product store. They sell one widget at a certain price point and they have one manufacturer and it's like super clean. In reality, it's a little bit more complex than this, but same process applies. This is an aim to essentially show you, really captured below the line here, all of the associated variable costs that occur on each transaction that's sort of like running through your retail store or e-commerce operation. So you have things like cost of goods, you have any discounts that you apply to the average order. So, like you have a 10% pop up on your site, 50% of people have a take rate on that. Average discounts like 5%. You have any returns as well. So like an assumption of what is going to be like the dead stock value and someone just sends it back. We have to incur that as a cost as well. Then you have merchant processing fees from places like Shopify or whatever. These are just placeholders that could be more, they could be less. And then you have like, assuming you're not charging for shipping, you have the shipping expense that's incurred to the customer, fulfillment cost. These are all variable costs. Like anytime someone comes to your site, places an order, it goes out. All of these are being incurred on a per unit basis on your P&L. So that basically gives you like a whole slew of costs where you end up with a certain landed gross margin to the customer. So for every $70 order that you have, there are associated $26.33 in cost. That means you have $43 left over. In theory, if you're looking to like break even on customer acquisition and then hoping sort of the P&L is supplemented by repeat customers coming in and driving like full margin orders that are then converting into contribution margin and profit for the business. Basically, if you have $43 left over in revenue after all your costs, you can spend up to $43.67 in customer acquisition to break even on that order. Or if you look at it like a ROAS term, it's a 1.6 when you factor in the average order value. So the key thing in understanding like what's happening with the tariffs is most direct-to-consumer brands are sourcing from overseas. There's a hot update to this video that the tariffs have been paused for a large majority of those customers, but or a large majority of those countries, but China is still intact. And actually, the tariff rate that I have here is now, I think it's 120%. So we'll update that. But the main factor here is like there's margin compression because this line item, cost of goods sold, is going up with the interference of tariffs in the equation here. So even at, we'll do it first in like the conservative estimate, as a 54% tariff adds an additional $3.24 of cost of goods sold. You can see that everything else remains the same, average order value, all remaining costs remain the same. We're down to 57.76% gross margin on that order, whereas before we we're at 62.39%. We're basically losing like 5 percentage points of gross margin, which then affect a lot of other things as well. So whereas previously you could spend up to $43.67 on a customer to break even, now you're down to $40.43. So the costs sort of like all flow through in different directions of the business. But really the larger impact here is if you scroll down and you look at like a normal direct to consumer P&L, obviously we have starting as like the top line, we have 100% revenue. Let's say in a normal situation, 40% goes to cost of goods sold and cost of delivery. Let's say the brand is spending like 30% of revenue on advertising. Again, could be more, could be less, but generally like around that figure. 20% on OpEx. So headcount, office space, tooling, et cetera, all that goes in there. Let's say a normal brand, like again, I think this is like actually a pretty positive situation, is if they're operating at 10% EBITDA. Now, if you essentially lose, I'm just going to round this up to say, 5% gross margin. We now add that to cost of goods, cost of delivery, and it immediately flows through to the bottom line. And we're now talking about a brand overnight going from essentially 10% EBITDA to 5% EBITDA. That has obviously tons of ramifications down the line and like immediate that brands sort of need to respond to. So there's obviously a few levers. We're going to mostly focus on like advertising and what you can do there. But, in theory, like what people have talked about is, okay, I'm just going to add that cost back to the customer. So I'm going to add the 324 back to the top line and see what that does. As you can see, directly passing the cost along helps, but it doesn't actually recover the full loss of margin, because we're talking about like dollars and then percentages. They don't all necessarily like move in fully a linear fashion when we're adding those costs back. So again, that gets you partially the way there. You can do things like maybe we're not going to discount as much. Maybe we're going to negotiate our terms with our suppliers to drive down better costs and things like that, which are all like levers to get you there, right? But there's like pain involved in all of those. You raise prices, you probably like suppress some demand. So there's obviously things that are factoring in there. The other option I think we want to talk mostly about is like, if we scroll back down here, okay, we now have 5% more, 5 percentage points more on our COGS / cost of delivery line item. What else can we influence here? Okay, you can influence OpEx. What about advertising? Like, I think this is one that I've seen some people on Twitter start to talk about, and I think it's a really important one, especially in the context of discussing incrementality, which is the key thing regarding incrementality testing is like, can you cut spend that is not essentially adding any value to the top line, right? Can I turn off brand search and have basically no impact to revenue, but drive down my advertising expenditure as a percentage of revenue? Can I shift budget from a channel that is incremental but not really on the spectrum of like profitability to one that is incremental but much more profitable, or close to that profit number that we're shooting for in terms of like allowable incremental ROAS or incremental CPA, and like compounded over time? We think there's probably like a decent chance that what you're doing with advertising right now, you can recover some of that margin directly through there. And it doesn't only have to be, okay, how do we raise prices to customers? How do we negotiate with our suppliers? All these things, like, let's look at advertising as a piece there to lever. Because again, like, it's as simple as if we can cut that by 5%, you could see we're sort of like apples to apples here in terms of EBITDA remaining the same, even though we've now added an additional 5 percentage points of COGS to that line item there. So that's the setup for the conversation. I think fundamentally, And again, it's actually worse than this for the time
Yeah,
being. If this
is
is
this
not
dynamic? Is this dynamic? Can we
for
see like
sure.
the new tariff rate would do in terms of the hit to gross margin? Like at that,
Yeah. Do you know what I don't recall what it is. Is it 110%? Let's just go with that. Yeah. So we're basically, I mean, we're at 50, 55 before, we're at 110 now. So that 5% loss is now a 9% loss, or, roughly like 10%. So the same thing factors in here, right? So like before, if we have to find 5% of cost savings, now we have to find 10 percentage points roughly to like break out as even as we were in terms of like where we were 3 weeks ago before any of this was actually like on the table. So
yep. So
um,
if you're
yeah,
manufacturing in China and you get hit with this tariff, you've basically wiped out your EBITDA. Like in this,
for
it's
sure.
like 9% if you're doing 10% in EBITDA, that you've like if you don't change anything, you've wiped it out.
Totally. Yeah. I mean, again, this is like a simplification, but it's like a severe impact that flows right through to that bottom line.
And Nick, like the point on the advertising is it's you really have to thread the needle because you don't want to, I think you mentioned this, like you don't want to cut the spend that's generating revenue. And this is where like attribution might show you in a Google Analytics report that like your highest ROAS is coming from Google brand search or PMAX as an example. So then a lot of brands might, funnel money there and cut the other stuff. And this is where like I would say
For
the
sure.
incrementality piece is just important of like making sure you're cutting the spend that's you're saving and protecting the spend that's actually working hard.
Definitely. Yeah. I mean, we can go down to 0% here and like we're going to be doing a 35% EBITDA business, but your revenue is going to tank, in the case of the advertising actually doing something. So that's not an immediate or like a prudent long-term solution. Of course, like there's probably some cutbacks that you want to make. I think it's about like smart, an intelligent way approaching that, making the cutbacks in a way that's actually like tied to revenue performance and not just due to like correlative performance that you're seeing in like MTAs or attribution inside of ad platforms and stuff like that. So
Yep.
um, yeah,
Yep.
that's the setup.
Yep. Super helpful. But we're gonna switch gears over to marketing and like those things that we can do to make sure we're still investing in the revenue generating media. But before we move on, Chandler, you had a point about like money today, the value of money today versus the value of money tomorrow, specific to this model. Do you want to jump in here?
Yeah. So this is a really important point as marketers are thinking about really, I think, and this will get into how we connect marketing to finance and having empathy for like the supply chain folks and understanding like where some of this pressure comes from today. It's important to understand that from like a cash flow perspective, I mean, the tariff changes constantly in flux, so it'll depend upon where your company is producing and shipping from in terms of like how you get hit. But like that comes into effect basically immediately. Like if you've got a purchase order in place, and we're talking to brands who are in this position, if you've got a purchase order in place, you're going to get hit with those tariffs on that coming purchase order for like inventory in the next 3 months. And you have to think about from the perspective of like what drives the performance of your business, how to contextualize the fact that like you're going to lose profit now, and then you're going to only be able to get back the money on that more expensive good once you have it in your warehouse and available to sell. So as you think about like from a marketing perspective, the implications of this, you could be like, oh, well, this is on products that aren't going to be, sold for a while, but it hits your business now before you even have the opportunity to start selling that product. So it really is a problem for your business today. And that's where it becomes really important to think about like not just what's incremental to the business, and we'll talk about this a little bit later, but not just what's incremental to the business, but also like the timeline of that incrementality of like if you're looking at a channel that's going to give you a 2 ROAS over, let's say, a 2 month period versus one that is like similarly effective, like a 2 ROAS on a 5 week time period, from your finance team's perspective, that 5 week is like notably better.
Yep.
Yeah. I think the big point there is like the spreadsheet that we looked at, it was nice and like itemized out. So the cost of goods is increasing as a percentage of every individual order, but like it doesn't look like that bad when you itemize it out on a per order basis. But like Chandler's mentioning, if you have $1 million of inventory coming in and now there's 100% tariff, you actually have to front the cash for $2 million of inventory when you're only planning for $1 million of inventory. So that's like it's like a shock to the system. Is like the immediate sort of like cash flow thing that's happening.
Yeah.
Yeah, and this is why, like, we'll get into this, but like marketing and finance can get really close here, with marketing being like, I understand the pain that you're going through, because they're going to sit there and write those checks, and they're going to come to marketing and be like, how can you make this better? And doing that from a perspective of like, what's driving incremental value? What's going to keep us humming along at top line, while also offsetting the fact that like we are going to lose that money, not tomorrow, but like in a couple weeks, it's really going to help bond everyone together on like being in a shared mission and doing what's right for the brand.
Yep. Okay, on that note, that's a good moment to let's pull this through to marketing. So Nick just showed the spreadsheet. We were looking at advertising as a percentage of revenue. Chandler, like talk to us about, so I want to talk about, how to think about these budgets. But first, like, how do marketers understand like the profit value or loss tied to their marketing spend? Because I know like we talk in these acronyms, like talk in terms of ROAS and CAC, but like how can marketers actually understand the profit tied to their ad spend? And then let's dovetail that into all right, what do we do from here in terms of practical advice?
Yeah. So the first thing, and this is not just advice for this situation, but really for like all marketers at a brand, is to like talk to your finance team and just tell them like, I would love to learn a little bit more of like what our costs are. How expensive is it for us to like produce our product? The big thing that you can ask is like, what are our landed COGS? So like once you take into account like everything from producing to getting it in the warehouse and ready to sell, and even like any costs that you incur by means of like shipping to the customer. If you go to your finance org and say like, I would love to make decisions from the perspective of like our landed COGS and profitability, you're going to be, one, ahead of like most other marketers, and two, your finance team's favorite marketer, because so much of the friction that can exist between finance teams and marketing teams is this belief that like finance is there to slash budgets and marketing is there to like spend money on sexy things that don't drive the business forward. And especially in the case of like growth marketers, most growth marketers like love data, live, if you've been at like a Shopify brand or any brand that's got like active dashboards. I don't know about you guys, but like you sit there on like Shopify probably more time than you should spend just being like, let's see numbers go up. Like I want to see numbers go up. And on the finance side, like they want the brand to grow. Like no one, not no one, but like most people aren't trying to be at like a stagnant brand that hums at like that 35% EBITDA that Nick mentioned. That's like, great, this is a profit engine that's never going to be more than like $4 million. Like people want to see the growth. So come together with your finance team, ask those questions, and then where you'll land is something hopefully like this, where we're going to take your marketing spend and we're looking at just like a set of incrementality results here. You're going to take your spend, the sales that you drive from it, and then the profit that you get from each sale to contextualize what does each channel drive to the business. And I'll flash over to like, this is an overly simplified like unit economics view, but if you're thinking about a business that let's say has like 65% gross margin, 90, excuse me, 90% net revenue, $30 COGS, every sale generates $60 in gross profit to the business, right? Like that's your baseline. If you go back to Nick's sheet, that's sort of your like break even point on like dollars out equals dollars in from just like gross profit. This doesn't even take into account like all of your variable costs and like headcount. isn't really factored into this either. But if you're just taking into account like, hey, what do we spend on this product to like go from having nothing to having something in our customers' hands per order, you get that like $60. And then you can contextualize that. And this is where incrementality is like so critical, right? Because if you're doing like last click attribution, or if you're doing some sort of triangulation, you may not fully understand like what's driving your business. But if you're doing comprehensive incrementality testing, you can see with this spend versus without this spend, or with this tactic versus without this tactic, here's what happens for the business. And you can bring that all together to get a sense of what the profit is per order, and then what that ultimately means for your business. So what we have right here is a V1 with testing of like baseline of all this brand's big channels. So like TikTok, Meta, you see super big, YouTube, PMax, and Hulu with live TV. Picking on Hulu, I used to work there. It's fine. I'm sure they're cool with it, even with Disney. Um, but you'll see a V1, and then what you look at here is what does each of these contribute to the business from a baseline gross profit perspective? And this takes into account not just your incremental CAC. So, and here we're not talking about CAC by means of like customer acquisition, talking about like overall sale acquisition. So this can be the combination of like new customers and repeat customers. It's dollars out versus orders back in. Contextualize that on both the incremental CAC, but also like the scale of spend really matters here, right? Because something that maybe is, let's say, lightly negative, but a huge chunk of spend can take away more from the business than something that, let's say, is lightly negative, but is much smaller in spend. You can kind of compare the Meta versus PMax here of like $50,000 in difference, despite the fact that the incremental CAC is like $3. So this is like the first point. Then your objective as a marketer is to think about not like where do we have positive, because I think we can be honest that like there are lots of places that like channel by channel won't inherently be incrementality profitable. And we won't go super far down this road, but it's really important to note, and Nick and Olivia, you both talked about this, I think it was a week and a half ago, 2 weeks ago, that if you're actually thinking about your business profitability, you probably don't need every channel to actually be on a per channel basis profitable. There's an organic baseline that you've got that, like, if you factor in, let's say 50% of your business would still exist without marketing due to like long-term organic awareness, any sort of like SEO stuff, like everything you've done in the past few years, your real targets may be a little bit different. This is a simplified view looking at like pure dollars in, dollar out. If you need each channel to be profitable, starting here, and then you take this like a phase two perspective, which is like, where can we move money from ultimately less incremental to more incremental? So what we've done in this example, it's really simplified. I also know flashing between screens isn't super helpful, but you see this is the product of some like spend down testing on Meta. So for Meta, we went from about $1 million in spend to 25% cut. You found that point of diminishing returns. You see this is now profitable. That in itself is a net $130,000 swing, which is a crazy thing to think about. But for marketers, when you're thinking about like, how important is it to find those little parts of CAC improvement? It can be so dramatic for the business, because in terms of like your dollars out, that is directly like cost to the business. Revenue in is profit adjusted, right? Let's say you've got a 65% margin, you make an additional dollar, that's 65 cents in, but a dollar saved is a dollar directly into your bottom line. So here they ran some diminishing returns testing. They cut spend on Meta by about 25%. And then the net of that is like plus 130K. Then they did some testing on Hulu, pulled about 100K from there. You see incremental CAC improves a little bit, goes from 100, 94, clearly at a point of diminishing returns already. They've probably got some optimization to do, sharpen the pencil, do some creative testing, but they move that over to YouTube. You see the YouTube incremental CAC here is a little higher than it was before, 46 to 51 with the additional spend. However, the net of this savings on CAC, moving that spend into a more incremental place, is an additional $24,000 in value. This is a sequence of like sort of 2.5 tests here. Like the Hulu Live TV YouTube one is a 3-cell test that you can run. Meta would just be like one spend level test. And as a direct result of being firmly grounded in like what incremental CAC you need to see to be dollar in, dollar out profitable, and making some like relatively small changes that didn't actually cut overall spend that much. The overall spend here went from like 2.1 million to 1.85. So like about a 10% drop in spend led to a $154,000 profit improvement. So this is sort of the broader context and how we start thinking about the grounds of like, where do you move from more or less incremental to more incremental, and really understanding like the profit impact that can have.
Yep. And this is powerful because this is assuming you really don't even have to reduce the budget. This is just pure kind of reallocation. Before you've even reduced budget, you've found another $150,000. I would say that like the part I have a question on is like, walk me through this journey of like phase 1 here to phase 2. Phase 1, what you're showing is like, how do you get that incrementality data? I'm assuming you've run a test. And then to get to phase 2 and see those improvements, you make changes and then run another test. Is that like the order of operations here to go from phase 1 to phase 2 and see that profit improvement?
Yeah, I think if I'm following you, yes, you're going to start with like, you're going to run your initial test, or if, you're one of the great brands who've been working with Haus, you've got a ton of great testing data in the past. You'll look at where each channel is at. You'll gauge from how long ago that test was, how relevant it is. And then you can actually even go directly into like that next test. So let's take the Meta example. You ran a first test. Let's say it's in the past couple months. You have that read on what your incremental CAC is on that $1 million in spend. Assuming, and obviously lots of caveats here, that you haven't made like massive strategic changes to how you've run the channel, you could move in to a next test that is as simple as like a 2-cell test at a lower spend level, because from this point, let's say you're a brand that like has to run at like dollar out, dollar back in profitability. You're a little above threshold. That this is about 50% of your spend. The next thing you could do, even before you make like other big changes, is just see like, are we at a point of diminishing returns, and just move directly into a test at a lower spend level and see like, where does that get you? And then from there, you can like make an additional change, test that, but really like starting from a recent test and saying, well, what are the core questions that might exist from this? Do we feel confident in our creative mix? Do we feel confident in like the spend level? And then moving directly into that next test.
Yeah, awesome. All right. That was what I was trying to get at, is like the way you get to that incremental CAC is through an experiment. That's how you get to those incremental CAC numbers. And then the way you kind of measure whether that improved the business is by like the follow-on test to understand, okay, what is our incrementality now? So just to kind of like orient folks around where those numbers are coming from and how they come in. Okay, great. I think now let's make it real. Like we just talked about hypothetical experiments that you could run. I think there are probably a few categories of tests right now that we would recommend to almost everyone impacted by the tariffs. So we have 3 categories of tests. I'm going to go ahead and share my screen here, and let's all kind of talk through these experiments and make it real for folks in terms of what they can do tomorrow with Haus. So let's talk about spend decrease testing. I'd say this is going to be one of the most common common tests if you need to reduce OpEx and quick, how to do so in an intelligent way. So Nick, talk us through this design and how it works mechanically as well.
Yeah. So I think the easiest way to think about this sort of test is oftentimes what we see at Haus is brands are kind of consistently overinvested in one of their core channels. So like we might test Meta and we might see really, really strong lift, meaning like, hey, we're telling you from a Haus perspective, if you turn off Meta, your revenue as a business will fall by 40%, right? So like clearly Meta is like the business essentially in terms of like driving customer acquisition. But what we sometimes see is that although they're driving very, very strong lift, you might see CAC start to degrade, like incremental CAC start to degrade. And that's reflected in sort of like the readout you'd get from Haus would suggest the cost per incremental conversion, or we would call it like the CPIA, is way higher than where you want it to be based on that unit economic calculator that we looked at in the first couple minutes of the call. And if you think about it, as you're like scaling up these channels, it's not one blanket return across the entire tranche of spend. It's not saying that like, at a $100 daily budget, your incremental CPA is as high as it is at $1 million daily budget. Like there's like ebbs and flows in between, and we would call that like the marginal CPA that's occurring between different spend levels. And pretty consistently, what we see if we have a customer that comes in and runs this test where we see big lift, but kind of questionable efficiency, it's always a case of like, okay, let's try and pull back some spend on this platform to see, when we cut 15% of spend relative to the one read that we do have, let's take the delta between those two tests and understand what is the actual like marginal return on the last 10% of spend that you're putting on Meta. So we have like 0 to 200K is very, very efficient. 200K to 500K is like moderate to average efficiency. And then when we get to like 700K to $1 million investment for our total investment for the month, it's like the CAC balloons on that segment. In reality, what these spend tests allow you to do is isolate what those points of return are from 0 to $1 million a month in spend and say, hey, like we know that this top 10% might be driving some revenue for us, but if we look at like the marginal CAC on that, it's explosive and it's basically driving our aggregate return down the tube. You could virtually like cut that spend and see very, very little impact to the overall lift that the channel is driving. And then go back and say, okay, I've just cut very, very unprofitable spend. The channel is now working very, very well. It's still driving a lot of lift, but I don't have this like very unprofitable segment weighing down the entire return of the entire channel. I can either in this circumstance, like just not do anything with that spend, right? Like I can just repurpose it and then cut advertising as a percentage of revenue expenditure, kind of like we talked about on that unit economics sheet. Or to Chandler's point before, we can now start to look to other avenues, either from previous tests that suggest like, hey, our first dollars on CTV or TikTok or like this new channel that we're testing into is very, very effective on that early tranche of spend. I'm going to get 50% improvement on my CAC by using that budget in this new avenue versus keeping it inside of Meta. It doesn't have to be Meta in this case. It could be any channel really that's hitting diminishing returns. But that's the idea behind these spend level tests. It's essentially like, let's figure out the point on the spend curve that we can essentially like turn off with very, very little impact to the actual revenue that's being driven from the entire channel. And then either repurpose it as cost savings or actually just go back and find another place for that that's going to be performing much more efficiently. And again, those two things both sort of work together to then accomplish that early goal that we talked about, which is cutting intelligently your ad spend in a way that's not impacting top line revenue.
Yeah, and just to orient folks with how this works, like you would basically, and we would do this in a way where the stats here matter in terms of splitting up the country into a few groups, where one part of the country is getting one spend level and another part of the country is getting a different spend level, but that those two groups are like statistically indistinguishable. So that's how you run this test, and I think Cody had a very kind of like salient example of this on the Marketing Operators podcast, where he talked about Meta, huge lift, not profitable, pulled back, and basically saw the same returns. So it's just like a very quick win in terms of some like opportunities and pockets we can uncover. Awesome.
Totally. And especially on like big channels too, right? Like if you have something that's spending a boatload of money and like, you know, maybe you're spending 5 to 10% of your overall revenue on a channel, and you can figure out how to chop 10% of that spend without actually losing any of the impact that the channel is driving for you in terms of top line, like that can immediately impact that P&L statement that we looked at.
Yeah.
Yeah, and it makes sense too on like how the channels are run, right? When you think about like the whole thing being predicated on like auctions and how they're trying to reach people who could be a fit for your product, of like the more people you try to reach, maybe the worse the fit can get, and the more that you have to rethink. I mean, there are plenty of brands who spend tens of millions of dollars on Meta. It's maybe not that like you could never get to that level of spend, but because you need the right creative to match the additional audiences that you're trying to grab in the auction, that you maybe need to take a beat on like where you're at now can scale to a certain level. Let's keep it running profitably at that level, and then revisit like what would you need to do strategically that maybe in a couple months you can come back and like push back up and be successful in broader auctions.
Yep. And like the incentive issue here is it's so messy because you have all these voices in your ear from folks who are like incentivized to get you to spend more, that you have to resist that urge of like it's like creating this like kind of fear around, well, if you pull back here you might see these kind of effects, and it's like, no, like if we're seeing it here we can feel pretty confident that this is a safe bet, you won't be impacting revenue, and that you can pull back intelligently. So that is just my advice, is to be skeptical of folks who are just constantly telling you how good everything is and that you can take on more budget, because we often see that there is some fat to trim. All right, with that, let's move on to the next one. I love these types of tests. I think um, they're like a little less common than channel level tests, these tactical tests within the channels, but they are so impactful. And if Meta, and Google represent a pretty significant share of spend, just improving Meta and Google over time is really high value. So, Chandler, do you want to talk through this slide and just some of like the tactic level wins that we see when you test in this way?
Yeah. So, as you're thinking about tactic level optimization, both in terms of like places to cut, but also places to redistribute, and we're going to get over to that awesome Javi case study on the right there in a second. The goal is to be smart about finding the places that truly add value to your business. And one of the big things to think about as you're doing that is trying to identify places where you might be having a tactic step in to the conversion journey, such that maybe it looks really good on last click, maybe it looks good on MTA, but actually its place in your funnel isn't incremental. And I think, we can talk about the different places where that can happen, but it's really about proximity to the conversion event, right? How close is someone to already buying when they're getting hit with an ad? And that can come back to like retargeting and remarketing. That's not to say that those can't be incremental, but can be good places to test to say if you've got heavy spend going into past 7-day add to cart retargeting, how incremental is that, right? What share are you going to get that would already convert? With ASC, there are lots of ways that you can run it. You can have a 0% allocation to retargeting and remarketing. You can also have a 30% allocation to retargeting and remarketing, right? It's very different in terms of who you're actually trying to reach. And, not to go back to quoting our friends over at Marketing Operators, good friends there. But really, what you want to be doing is identifying your path to getting net new people. And the more that you are circling the folks who already are in your orbit and already likely to buy, the more likelihood that it's maybe not incremental. And Google and Meta, I mean, some of the best ad platforms out there, really sophisticated marketing. They're also very good at identifying the people who look good for the events that you're targeting, right? If you've got purchase event for 7-day click, 1-day view, and that's what you're optimizing towards, that's what they're going to give you because that's what you've told them to give you. And they're really, really good at doing that. So retargeting and remarketing become big pieces of that. However, you can sort of flip that idea on its head to find places where you can really add value in those same platforms by moving up the funnel towards prospecting. Let's talk about this Javi case study. Nick, you want to explain what they did?
Yeah, so I was gonna jump in, Chandler, when you were talking there, but I think like if you're listening to this and you're like, oh, this doesn't really matter because I don't do any retargeting. Like I don't have a dedicated budget to retargeting. So this is like I'm gonna skip past this. This is actually like a very clear example of the case study on the right, and I love this case study. It has been beaten to death a little bit. I feel like we talk about it all the time, but it's actually a really great example, and it's probably like my favorite one to highlight with customers. Um, where we're saying like bottom of funnel and top of funnel here, it's not actually a targeting lever. It's the sense of like the creative that's going into each of these different campaigns. So in this case, we're talking about two identical Advantage Plus shopping campaigns in the account, basically make up the entirety of the account. The only distinction is that what we're labeling as like bottom of funnel is just the different types of creative assets that are in there. So this one is heavily leveraged towards like statics with promotional text overlays, et cetera, like things that, if we talk about like creative doing the targeting on Meta, things that Meta will seed to people who are at the point of purchase essentially, and in that like most aware phase where they're either going to buy Javi or a competitor, or like they're definitely going to buy Javi, and this is just like something that we're sticking in their feed before they make the purchase. And then the top of funnel is more like video, problem solution oriented type content, brand introductory, etc. The key messaging here was that the budget was split prior to this test virtually like equally from my memory about these across these campaigns, because MTA and in platform were suggesting that like this bottom of funnel campaign was so effective, which makes sense based on how those assets are going to be favored in the auction and who they're going to be delivered to, right? They're going to be delivered to people very, very warm and ready to convert. Of course, the key incrementality question is like, did they need these assets then or not? So the budget was split evenly, roughly. But when we tested them, so we ran two concurrent two-cell holdout tests. And again, like to Olivia's point earlier, made sure that the markets were indistinguishable from one another to get like a clean test. We actually saw that the results were like flipped from in platform and MTA to what we saw in incrementality results. And these like top of funnel assets were dramatically outperforming bottom of funnel. And just talking to like P&L, I happen to remember like there was a shift at the end of this test, going back to Chandler's point of like, okay, these results are clear. Let's put it to the test. Like, let's move the dollars or some of the dollars out of bottom of funnel into top of funnel and see what happens. And we actually remember like there was an actual improvement to new customer MER for that period of time. Meta was a very high spending channel for them. So, making that shift on a very large percentage of spend led directly to like that financial metric for the business improving. So it's not even just about like targeting. It's even like the creative head to head within a channel. It can drive significant changes in incrementality.
Yeah, I mean, there's even a sort of parallel there if you think about like ASC being somewhat similar to like PMax, right? Of like PMax runs on the inventory you give it. And if you run PMax with brand terms allowed versus brand terms not allowed, you're sort of permitting it to exist in different auctions that are at different stages of the funnel, right? So if you think about this algorithmic buying, it's like really about what you're putting in and what that allows the machine to go target and whether that's right for your business.
Yeah, I love that. And I think the different conversion events or different optimization events in Meta is really hot test right now. Like everyone's wondering if I point the system to a shallower KPI, add to cart or something more mid-funnel, will Meta be able to prospect? We're pulling the data together. I don't know if it's like a universal winner. So I would recommend testing that and testing it for your own business because there are examples where it's not obvious that that's the move and that there's like tons of room to continue on these conversion campaigns. But yeah, there's so much opportunity here. And I think we all really love this Javi case study. Okay, I'm gonna move us on. I know we're almost at the hour. This one's interesting. I will set it up. We admittedly haven't run a lot of these, but I think they're potentially going to grow in popularity, just given the tariffs of if you're a brand with a lot of SKUs, a lot of different types of products, what if you force spend on creatives promoting the products that are higher margin for you? So we're hearing of some companies thinking about this of like, what if I just went harder in terms of my paid spend on the products that are delivering a better margin? So this could look like, one sell of just like your business as usual kind of like creative portfolio approach of just whatever assets are working and getting spent, I'm going to spend on them versus a sell where you're forcing budget in Meta to the higher margin products, or you like have one campaign where you're having up on these higher margin products. So Nick, Chandler, do you guys have any thoughts on this one? I think this one is probably going to be um uh become a little bit more common in terms of the tests in the arsenal for these brands.
Yeah, I think this is a really interesting one. It sort of crosses into that space between marketing and merchandising, right? Of trying to like speak to the products that you want people to buy. I think it's really worthwhile for people to test. It's going to be differently easy or difficult depending upon what your like product market fit is on your higher margin products, right? Or if they're like higher cost products and what that might mean for your customer acquisition costs and how you can model that out from just a perspective of like how much you need to spend versus what you're actually going to get back on products sold. But it's definitely like an interesting one because if you think about the levers that you can pull, right, in terms of improving your per order margin profile, like AOV is a huge one. And to the extent that you can, you know, profitably move spend towards higher AOV, that can be really net positive for your brand, especially if you can keep consistent cohort sizes too.
Awesome. Okay, let's switch gears a little bit to what else you can be doing outside of paid marketing. I think it would be disingenuous to say that like the only levers you have are in the world of paid marketing. It is a big lever. It is a big a big cost center. But there's a lot of other things you can do in the world of marketing separate from paid. So Chandler, I will just kick it over to you. I know you come from the retention world where you led retention at Magic Spoon. What do you got here in terms of advice for optimizing that side of the business?
Yeah, I mean, like you said, there's a lot that you can pull on. Sort of jumping from where we were just talking about of using your marketing to push higher AOV and higher margin products. Your marketing's one side of things, right? But if you think about your conversion funnel, there's also a lot that you can think about on the site merchandising side, especially if you've got ability to like do bundles, if you've got more premium SKUs, right? Depending upon the brand, like you might be dropping people from ads onto a landing page. They might even be going on to like a homepage. I know people have done a bunch of different tests in some brands, like it's actually best just to drop people like directly on the homepage and they can navigate themselves. if you can build out your site merchandising experience to push people to higher AOV products or encourage bundling, like that's a big lever that you can pull to continue to push on like getting more margin per order. The other thing that like I'm personally a big proponent of and did a ton of this in a couple of my past roles is in-cart upsell testing. And then to the extent that you can support it from like a fulfillment perspective, post-purchase upsell testing. There's like the short term and long term, depending upon how you've got your supply chain built. But the goal is like get high margin profile, small add-ons into the cart once people are already on the purchase journey. Because once they've started adding products to the cart, the distance that they have from converting is lower. So you can try to find opportunities to get them to tack on more. And like you'd be shocked at like how well some like small add-ons can do. I'll tell you, the bowl and spoon at Magic Spoon. Now, it's a dope bowl and spoon set. Like it's really great. I've got like 4 bowls and 3 spoons, so highly recommend. But like the add-on adoption rate is like really strong. It's a great like high margin tack on that can just add to your bottom line for your business, especially if it doesn't increase shipping costs. And like it's also something that if you're working with the right people, can A/B test too. Only only call out for everyone. If you're a growth marketer, maybe go into your CRO person trying to think about like how we can do it. Remember the 25% rule, which is that you cannot try to like upsell, cross sell to someone beyond 25% of what's already in their cart. So if you've got like $100 in product, you can't go to them and be like, do you want to add on this $70 thing? It's not going to work unless you've like figured out an extreme discounting where it's like actually a $300 product for 70. But even then you're going to be in trouble. Like find the little things that you can tack on, like $10 here, $15 there, adds a ton of value. So that's on the site side of things. Couple quick ideas on the life cycle side. I mean, there's a ton that you can do, but one of the biggest things, especially in tougher times, that is sort of counterintuitive is that discounting in some places can be really bad for you, but in other places, it can be valuable and it can be really important to find the balance. So Nick talked about on the P&L sheet, right, that you could like get rid of discounts and like that's great on like customer acquisition and in places where it's not incremental. But if you're thinking about like what can we do for the business to like get more cash up front, and there's user-based A/B testing you can do. Like I'm going to push incrementality on everything, like pretty much everything that you can do, you can test, is finding the places where the likelihood of churn that like someone would never make another purchase is extremely high and finding the discount rate that's still profitable that will get you like any amount of dollars from those people. And it can be tough when it comes to like brand consideration. There's a lot to think about, but the goal here really as you think about life cycle on like late stage churn is like some profit is better than none. And if you're sitting there looking at by your like A/B test and your cohort rates, a group of customers that their likelihood to ever buy again is like 3 out of every 100. If you can push an effective, profitable promo that can move that up to 5%, that is immediately more money in the door from your existing customer base. So I think in tough times, people can either say like, we can't do discounting, or they apply discounting like indiscriminately in a way that can like hurt them long term. And the goal is really like find the places where you can apply it as a tool to get cash that wouldn't have come in otherwise. And then in the places where you don't need it or where it's profit detrimental, don't use it. However, the final thing I'll say on like life cycle stuff is that if you're thinking about the long-term future of your business, if you're in a position to think like 6+ months ahead, do not fall into the trap of saying like retention's going to save the business. This is a time where you're going to hear so many people say like invest in retention, invest in retention. I'm here to tell you as someone who spent a lot of time in retention marketing that the amount that you can move your cohort retention rates with marketing only is so incremental as compared to everything that you will do on the acquisition side and everything you will do on the product side. If you have the exact same product mix, the exact same discount rates, you're acquiring customers in the exact same channels, you can push on lifecycle, but it will not transform the financial future of your business unless you've done like literally nothing in lifecycle, which like you've probably done some stuff, you've probably done some testing. So it's really important to like focus on that where you can, but be really smart on your acquisition too, and continue pushing for at least not dramatically shrinking your cohort sizes and finding profit on your customer acquisition costs. This comes back to what we talked about the very start of this, right? If you save $5 in CAC, that is profit to your bottom line. If you make $5 more within revenue from your retention, that's great. It's at a 60% profit margin, $3 more. It's not going to be weighted the same. And for each big step up in retention, it's going to take so much effort. I love retention. It's very important, but like stay focused.
Yeah.
Acquisition still important at this time.
Yeah, that's such an important note of like you need like step change performance improvements here. And I'd imagine this is probably true, more true of like older brands than younger. Like maybe younger brands do have a little bit more to optimize in the world of retention, but like brands that are like have been going for a while, there's just like only so much juice to squeeze. And so I find that folks tend to spend a lot of time like almost over optimizing for very little return. So that's a great note to end on. Very well said. Um, Both like Nick and Chandler. I was in the entertainment world for most of my career. I transitioned into ecom when I went over to Sonos, and like this is content that I would have absolutely loved as I ramped up into the world of ecom. I like ended up on Twitter, of course, but we're probably going to publish this for free, which is crazy, but it is an amazing crash course. Like I wish I had it when I was transitioning into ecom. So thank you both for your time. I know this is over an hour, and I hope it's helpful for everyone who's listening.
Cool. Yeah, it was
Thank you
awesome.
for leading it.
All right.